one.
Hello and welcome to BK Prama. I'm Hiral Daria. Overall, in terms of where markets are concerned, it's slightly muted move, but there is some bit of positivity that is emerging as well. We have Mr. G Chokkalingam, founder at Equinomics Research and Advisory, joining in. Welcome to the show, Mr. Chokkalingam.
Yeah, good morning.
Mr. Chokkalingam, let's start with the first stock that's in focus today. That's a Tata Steel. They've reported a loss on higher taxes as well as higher material costs. And if you see in terms of the stock price as well in today's trading session, down little between 4 to 5%. In the last 5 trading sessions, it's down around 7 to 8%. Steel companies overall are in focus as well. And there is a lot of expectation probably that there would be some bit of re-rating that could come in terms of metal counters. Taking both these aspects into consideration, what would your view be on a Tata Steel and what would you recommend an investor to do?
Yeah, very interesting question. Before you look at the Tata Steel, you have to look at the economic perspective. Worldwide, all of us know the growth has slowed down. On the other hand, the China is opening up, and therefore China can increase the output of steel in the short term itself. Third emerging trend is that India is now facing the import threat of steel. Seeing the robust import of steel, finished products. So considering all that, though Tata Steel comes from the most reputed management group, I would suggest staying away for some time in the short term from steel stocks, and in fact consider something like HDFC Bank, because the banking sector continues to grow at 15% year on year, the credit, which is at a very record high level. So I would suggest that one should be a little cautious on steel and other metal space.
Right. So my next question is again a related company, which is Tinplate also, which is a subsidiary of Tata Steel, right? Now, probably we are seeing a contagion impact coming in on a Tinplate because when it reported numbers as well, even for that company, the profits declined by almost around 61, 62%. So overall, would you still have an avoid on a Tinplate as well?
If somebody is holding and making losses, they can continue to hold because long-term prospects of Tata Steel, even Tinplate, remains good. But otherwise, what I said for Tata Steel would be applicable to Tinplate. Tinplate also posted a 61% fall in profit year on year, and after that, it's trading at around 27 PE, on an annualized basis, which is highly stretched for a metal company. So as I said, one can look at large banks. And second, one can look at the capital goods sector where the government focus is. And therefore, I would suggest that instead of buying Tinplate, one can buy stocks like Siemens.
Right. Moving on, LIC Housing Finance reported numbers closer to market hours, closing yesterday. And clearly, if you go to see, there has been a decline in terms of the profitability by almost around 37 to 38% on the counter. What would you make of a LIC Housing Finance? Because the NII has jumped by around 10%, and it's the profitability that has declined overall.
Yeah. Unfortunately, it is trading at 20% discount to book value. But still, I would say that if somebody is losing money, they can hold, because historically, once in 3 years, it has come back above one-time book value and it rewarded the investors. But fresh buying, I would not advise, because the competitive space within the housing finance segment has increased manifold, and the banks are also giving stiff competition because of access to cheap CASA deposits. And secondly, it is lacking the momentum investor attraction in the short to medium term. So as I said earlier, I favor large private banks or capital goods. Third area which I would suggest to retail investor is to look at the real estate asset company which are holding a rich assets, at the same time balance sheet is strong. So one such name is Oberoi Realty. Now the commissioning of a metro station also positive for Oberoi Realty. It has got access to new metro train, and a lot of developments happening, and a lot of land they have bought in the recent time. I'm very bullish on land prices shooting up further, and therefore I would suggest Oberoi Realty buying instead of LIC Housing Finance.
Right. So that's with LIC Housing Finance. Muthoot Finance, now that stock is trading under pressure. And if you see in terms of the profitability, that has dropped around 11% on a year-on-year basis to around 927 odd crores, right? But overall, if you see in terms of estimates, it still beat on, analyst estimations as well. Gold prices probably, has been something which is on the higher end. So taking both of this into consideration, what would your view be in terms of a Muthoot Finance, and would you recommend a buy?
It's a good management. They have created a lot of wealth in the past. Still, there are two structural changes. One is that the banks are eating into NBFC's market, especially in segment like a gold loan, where the NBFC has done phenomenally well in the recent past. So the banks, because of access to cheap deposit, they have captured a substantial portion of the gold loan. And I am sure in other segment also they will pose stiff competition to NBFCs, which do not have access to cheap deposits. Second structural change, despite aggressive rate hike across the world within India, still, the lending rate, if you see, far below what we used to have historically. Even at the peak of the interest rate cycle, if you compare in the past and now, we are still very low. That means, the banks have better advantage because of the low cost deposits. And therefore, the other theme which I would suggest investors to look at is something like a Oracle financial software, that is OFSS. It's MNC trading at a 13-14 PE and 5-6% dividend yield. So I would prefer, Oracle financial software solution rather than Muthoot Finance.
Right. So that's a Muthoot Finance. Now, moving on, we do have Nykaa as a focus stock today. But if you see last week as well, Mr. Chokkalingam, the new age tech stocks, it was a pretty mixed week for them, wherein Nykaa was the biggest gainer. If you look at stocks like a Nazara, which slumped in trade, Paytm was in focus as well. So Ease My Trip, Zomato, Fino Payments Bank, all of these saw good gains coming in, right? Now, Rate Gain, Traction Technologies, Delivery, Dronacharya from the SME space were few of the stocks which actually declined in trade. So firstly, your view with regards to a Nykaa, with the way the stock movement has happened, and if you have to compare it in terms of the business, and anything from the new age tech stocks that do you like?
I would not suggest Nykaa, because I have been holding this view ever since these companies have gone for IPO, that they are yet to complete the venture capital cycle. I mean, what I mean is that, they should have been listed after they have proven their profitability and profit growth, but they rush to the market to invest. And because if you look at even the industry estimates, still it is trading at around 200 PE. So I would say that this is not a kind of stock for the retail investors. They should continue to stay away from e-commerce companies which are trading at more than 100 PE.
Right. And any of the other companies from the new age tech stocks that you would want to recommend?
I'm still not comfortable. I am looking at them. Maybe if they fall another 15-20%, I can definitely come back to this channel and pick up a stock which I consider the best in this space.
Right. Moving on, Aarti Industries is another stock to focus on as well. The company has reported numbers today's session. The stock is trading under pressure by almost around 5 to 6%. Overall, the earnings growth was pretty solid. However, we did see some major weakness that has come in on the counter. What is your read with regards to Aarti Industries?
I would, suggest not to buy. It's a good management. They have created a lot of wealth through various verticals of Aarti Group. There is no doubt. Unfortunately, there is a structural change which I have not seen in the last 20 years. The kind of magnitude of the fall in the realization of all user industries. You have a dye, pigment, pharma, life sciences, chemicals, agrochemicals. Across the board, first time I'm saying in 20 years, the severe fall, erosion in the realization. These are all the user industries for Aarti Industry, and Aarti Industry trades at around 30 PE. So I believe, unfortunately, it can correct a lot more. Not only Aarti, but this kind of stock in the entire chemical space. So therefore, I would stay away from Aarti Industries.
Right. Mr. Chokkalingam, we still have some more time on the show. Let's pick up a couple of other stocks as well. Hindalco, the company is going to report earnings, and ahead of the numbers, the stock is trading under pressure. It's down almost 3% in trade. What's your view on a Hindalco?
It's a good company. If somebody is holding and losing money, definitely one can hold it. And in case loss is enormous on a very significant fall, one can buy for long term. But short term, as I said, for Tata Steel, the entire steel and metals are going through tough time because of slowdown in growth, and still aluminum global prices are far below the 52-week high. So therefore, short-term investors can stay away, but those who are interested in long term, for every significant fall, they can buy Hindalco.
Right. Apart from that, you have a ITC also, which is trading under pressure in today's session. But overall, the stock did scale fresh record highs as well after reporting Q3 numbers. So is it that we are seeing some bit of profit booking that's coming in on the counter? Because clearly the brokerages are expecting an upside of at least 20 to 25% in terms of an ITC. So what's your view with regards to an ITC?
I have a serious doubt whether it can get another 20, even 15% return from here in the next close to 1 year. Valuations are stretched, and all segments are. Even if you do SOTP, it's stretched. And secondly, I believe that the government should be smart enough to utilize this opportunity to offload the share and make money and strengthen the balance sheet. So that risk is also there, and therefore I would say that it's a good sell on every further 2-3% rise.
Right. Apart from that, the auto space, you have some bit of pressure that's building in today's session. If you see Maruti, Tata Motors, as well as a Hero Motor, all these three counters are trading under pressure. Now, taking the January auto sales numbers that have come in, the management commentary that has come in as well, from the earnings, what's your view on the auto space as a whole, and any good buys that you would recommend from this space?
Yeah, I can suggest two stocks. One is Maruti. I looked at Maruti intensively. I am pretty confident that the SUVs they are going to launch, 3-4 models, they will be able to deliver and improve their market share. So therefore, one can look at Maruti. And second space, as I completely agree with you that automobile sales have picked up, and the entire automobile as a whole, they have posted 14% year-on-year growth in January, which is positive for tire stocks. Yes, it is positive for many components, but why I am stressing tire stock is that the two key inputs, namely the natural rubber and also the derivatives of crude oil, they have come down a lot on year-on-year basis. So therefore, I would suggest MRF. One can consider. I think the time has come. I have been saying for a long time that it should cross 1 lakh, and it went close to 1 lakh and then dipped. Now the time has come for MRF to cross 1 lakh rupee target, which has been my target for several years. And I just want to disclose that Economics has bought MRF.
Right, and that's everyone's view as well, and everyone's eyeing that 1 lakh mark with regards to MRF since quite some time, and that's very rightly put. But thank you, Mr. Chokkalingam, for joining us on the show and giving us your views and your recommendations for our viewers and investors. Thank you. Stay safe and speak to you soon again.
Thank you very much. Thank you.